deep within the fortified vaults of Lower Manhattan, buried beneath layers of concrete, steel, and digital ledgers. A quiet alarm has been triggered, not a siren you can hear, but a number on a screen. A number so staggering, it has shattered the foundation of a century-old market. For $0.8 billion. Gone. This isn't a heist. There were no masked men, no elaborate drills. This was a silent, legal, and terrifyingly efficient withdrawal, executed in plain sight, while the world was looking the other way. The custodian? The most powerful bank in modern finance, JPMorgan Chase, their silver vault, is now at a crisis point unseen in its history. And the entity that walked away with the money has left behind not just an empty vault, but a single, burning question that threatens every investor, every central bank, and the very structure of the global economy. What do they know that you do not? Welcome back. You are watching Wild East Stories. For those who are new here, my name is Marcus. I am writing to you from a study overlooking the old financial district of Vienna, a city that has seen empires rise and fall on the whims of capital and commodity. My work, my obsession, is tracing the silent flows of money and metal that shape our world, separating the noise of the headlines from the seismic shifts happening beneath them. I am not a speculator. I am a cartographer of crises in the making. The story begins not with a bang, but with a void. In the regulated, meticulously reported world of commodity custody, data is the only truth. And in early 2024, the data emanating from the COMEX-approved vaults operated by JPMorgan Chase in New York began to tell a disquieting tale. Registered silver inventories, the physical silver readily available to settle futures contracts, the deliverable supply that backs the vast paper market, began a precipitous decline. The trend line did not wobble, it plunged. In a matter of months, over 45 million ounces of physical silver vanished from JP Morgan's eligible category, transferred into the registered column, and then delivered out. The financial value of this metal, approximately $4.8 billion. To the casual observer, this might be a statistical blip, but to an analyst, this is a silent siren screaming a five-alarm fire. Marcus approaches this not as a market event, but as a forensic audit of confidence. JP Morgan is not a mere warehouse. It is the pivotal nexus of the global precious metals market, a player so large its vaults and trading desks effectively are the plumbing of the system. For such an entity to experience a net outflow of this magnitude is not routine inventory management. It is a controlled detonation. The immediate, surface-level question is, who has the power, the capital, and the motive to move $4.8 billion in physical silver without causing a market panic? The answer eliminates almost every conventional player. It was not a herd of retail investors. The logistics and capital are beyond them. It was unlikely to be a single hedge fund, though consortiums are possible. The scale and stealth point towards a different class of actor: sovereign wealth funds, national treasuries, or ultra-high net worth family offices operating with a generational, not quarterly, time frame. They are not traders. They are strategic accumulators. The nature of the withdrawal is equally telling. This was not a sale on the open market, which would have left a price fingerprint. This was a direct, off-market acquisition of physical bars, likely negotiated in hushed tones over secure lines, with the metal moving from JP Morgan's vault directly into another, presumably non-bank, vault. This is capital seeking not profit, but sanctuary. It is a vote of no confidence in the financial system's paper promises, executed by the very entities that understand those promises best. The timing is the final, critical piece of forensic evidence. This exodus accelerated against a macroeconomic backdrop of persistent inflation, escalating global debt, and increasing de-dollarization rhetoric from BRICS nations. Silver is a unique asset. It is a precious metal with a monetary history, but it is also the critical industrial metal for the energy transition. Solar panels, electric vehicles, and 5G infrastructure cannot be built without it. Whoever removed this metal is therefore making a dual bet, a bet against the stability of fiat currency systems and a strategic bet on the tangible, inelastic demand of a global technological overhaul. The departure of $4.8 billion in physical silver from JP Morgan's vault is not an isolated transaction. It is a macroeconomic signal, transmitted in code. To decode it, one must move beyond the what and into the how. The precise mechanics that make this event not just notable, but structurally alarming. Marcus maps this anatomy in 3 layers: the logistical, the temporal, and the strategic. First, the logistical layer reveals an operation of daunting precision. Withdrawing 45 million ounces of silver is not like moving cash. A single standard COMEX silver bar weighs roughly 1,000 troy ounces. This exodus represented the movement of approximately 45,000 such bars. Each bar weighs about 70 pounds. The total physical mass extracted was over 1,400 metric tons. To visualize, this is a convoy of armored trucks stretching for miles, or multiple cargo planes filled solely with dense, gleaming metal. Yet, no such convoy was seen. No public shipping manifests were triggered. This was a shadow movement, executed within the closed-loop system of high finance vaulting. It indicates the buyer already had a pre-approved, audited vaulting channel, likely a non-bank, institutional-grade depository in a secure jurisdiction like Switzerland, Singapore, or even within a sovereign state's own treasury. The logistics prove this was a pre-planned, institutional-scale relocation, not a speculative trade. Second, the temporal layer, the when, provides the context that transforms a large trade into a historical marker. This drawdown did not occur during a period of market panic or soaring silver prices. It happened during a time of relative calm, even suppression, in the paper silver markets on the COMEX. The price was allowed to drift sideways or even dip slightly, a classic environment for large-scale physical accumulation away from the spotlight. The timing coincides precisely with escalating global tensions that threaten the very fabric of financial settlement. The weaponization of currency reserves following geopolitical conflicts and persistent, stubborn inflation that central banks have been unable to eradicate with interest rate hikes. The buyer acted not in reaction to a headline, but in anticipation of a protracted regime shift. They bought during the quiet, understanding that the storm, when it arrives, will make such discrete accumulation impossible. This leads to the third and most critical layer, the strategic intent. Why silver and why now? The answer lies in silver's schizophrenic role in the modern economy. On one hand, it is poor man's gold, a historic monetary metal and inflation hedge. On the other, it is the irreplaceable industrial catalyst for the post-carbon world. Photovoltaic cells, every significant electrical connection in an EV, and advanced electronics cannot function without it. The International Energy Agency projects a massive supply deficit for silver by 2030, driven solely by green energy policies. Thus, the entity that removed this metal is making a convergent bet. They are hedging against systemic financial collapse and securing a critical material for the next industrial revolution. They are not merely preserving wealth. They are cornering a strategic resource. In doing so, they expose a terrifying vulnerability. The physical market for critical commodities is infinitesimally small compared to the paper claims upon it. The entire registered silver inventory of the COMEX, the deliverable supply for the world's primary futures exchange, could be emptied by a handful of determined actors, as this event demonstrates. The vacuum left by the departed silver is filled by a more pressing void, the identity and motive of the acquirer. In the world of high finance, actions of this scale are signatures. By analyzing the forensic traces of the transaction, one can construct a profile of the entity on the other side of JPMorgan's ledger. This is not guesswork. It is strategic deduction, narrowing the field of global capital to a precise set of actors whose profile fits the evidence perfectly. Marcus approaches this not as a mystery, but as an intelligence assessment. The profile is defined by 4 non-negotiable characteristics: capital scale, operational secrecy, strategic time horizon, and a non-speculative mandate. First, capital scale. Mobilizing $4.8 billion in liquid capital for a single, non-yielding physical asset requires a balance sheet of staggering size. This immediately disqualifies all but the world's largest sovereign wealth funds, like Norway's NBM, Saudi Arabia's PF, or China's CIC, major national central banks, a handful of the most secretive family offices, think Rothschild or Getty levels of wealth, or consortiums of resource-focused billionaires. For context, $4.8 billion is a rounding error for Norway's $1.6 trillion fund, but a monumental, all-in bet for even a large hedge fund. The ease of the transaction suggests it did not strain the buyer's liquidity. Second, operational secrecy. The complete lack of price disruption or public reporting prior to the vault report indicates an operation conducted through bilateral, over-the-counter, OTC, channels, away from the transparent, price discovery mechanisms of the exchange. This is the realm of whisper trades. This level of discretion is a hallmark of sovereign and ultra-wealthy family dealings, where privacy is paramount and often protected by law. A public corporation or a typical hedge fund could not execute this without leaks or regulatory filings. Third, strategic time horizon. The buyer displayed zero concern for short-term price fluctuations. They were not trading silver. They were relocating it, with the apparent intent to hold it for a decade or more. This is the behavior of an entity managing intergenerational wealth or national strategic reserves. They are not measured by quarterly returns, but by century-long survival and influence. The acquisition is a permanent strategic adjustment to their balance sheet. Fourth, a non-speculative mandate. This was not a leveraged bet on higher prices. It was a defensive and offensive maneuver rolled into one. Defensively, it is insurance against currency debasement and banking system risk. Offensively, it is the seizure of a critical, finite industrial input necessary for economic and technological supremacy in the coming decades. When these four characteristics are layered, a compelling portrait emerges. The most likely acquirer is not a Western financial institution. Their mandates and disclosure requirements do not align with such secrecy. The profile points east, or to a neutral fortress. A sovereign wealth fund from a nation actively building its renewable energy infrastructure while publicly questioning the US dollar's hegemony fits perfectly. Or a consortium of industrial titans from the tech or energy sectors, securing their future raw material supply in the face of looming shortages. Perhaps it is a nation like China, whose government has openly encouraged its citizens to acquire gold and silver for years, and whose industrial appetite for silver is insatiable. The profound implication here is that the global system has entered a new phase of quiet conflict, the war for physical collateral. For decades, the US dollar and treasury bonds were the world's ultimate safe haven assets. This move suggests a pivot. A major, unseen player has just voted, with $4.8 billion, that the ultimate collateral is no longer a treasury IOU, but a tangible, useful, and scarce element buried in the ground. They have exchanged a financial asset, cash, for a real asset. They have, in essence, performed a quiet, unilateral debt-for-asset swap with the financial system. This transforms the narrative from a curious vault report into a strategic alarm. If one actor of this profile has made this decision, others are either following or will soon be forced to consider it. The precedent is set. The barrier to action has been lowered. The JPMorgan vault is not just empty. It has become a blueprint. The crisis, therefore, is not the absence of metal. It is the presence of a new, rational, and terrifyingly quiet strategy for survival in the next financial era, executed by the players who write the rules. The acquisition of the physical metal is the first domino. Its fall initiates a chain reaction that threatens the very architecture of the modern commodities market. The system is built on a fundamental, and now demonstrably fragile, premise that for every 100 paper claims on a commodity, only 1 or 2 will ever demand physical delivery. The $4.8 billion exodus was a demand for delivery on a scale the system is not designed to handle. Marcus now traces the fault lines this event has exposed, mapping the sequence of systemic failure that begins when trust in paper erodes. The first domino is the erosion of the registered stock. The COMEX system relies on its registered silver inventory, the bars specifically approved and available to settle futures contracts. This is the system's shock absorber. The recent withdrawal eviscerated a significant portion of this buffer. When this stock falls below a critical psychological threshold, it triggers a reflexive fear among all other paper holders. Will there be any left for me? This fear is not irrational. It is mathematical. If several other large players, even much smaller than the initial acquirer, attempt to mimic the strategy and take delivery on their futures contracts, the remaining registered silver could be exhausted within days. The system transforms from one of confidence to one of musical chairs, with every participant suddenly desperate to secure a physical seat. The falling of the second domino is both inevitable and catastrophic, the decoupling of paper from physical. As the scramble for real metal begins, a dramatic and permanent price divergence will occur. The paper price on the COMEX, set by digital trades and speculation, will become increasingly disconnected from the true physical price demanded in the OTC market to secure actual bars. A two-tier market will emerge. The paper price may appear suppressed by institutional selling of futures contracts, creating an illusion of calm. Meanwhile, in the hidden warehouses of Zurich, Singapore, or Shanghai, the physical price will skyrocket, accessible only to those with the capital and connections to operate outside the exchange. This decoupling shatters the primary function of the futures market, price discovery. It becomes a theater, masking a reality of acute scarcity. This leads directly to the third and most dangerous domino, the failure of delivery and the liquidity crisis. The COMEX, as a designated contract market, has a sacred obligation. If a holder of a long futures contract demands delivery, the exchange must facilitate it through its vault system. If the registered inventory is depleted, the exchange faces a failure to deliver. This is not a technical glitch, it is a default. Such an event would trigger an immediate, violent repricing of all commodity futures, as trust in the entire settlement mechanism evaporates. Capital would flee paper markets en masse, seeking the safety of physical possession or other hard assets. The resulting liquidity vacuum would spread contagion to equities and bonds, as leveraged positions across asset classes are unwound in a panic to cover losses. The derivatives market, a multi-quadrillion-dollar edifice built on the reliability of these contracts, would seize. The final domino is the strategic reassessment by nation-states. Witnessing a failure in the Western commodities clearing system, other sovereign nations would accelerate their own strategic withdrawal. They would no longer see New York or London vaults as secure repositories for their national wealth. A global, coordinated move to repatriate gold and silver reserves would begin, not as a political statement, but as a fundamental risk management necessity. This would permanently alter the global financial landscape, balkanizing the storage and trading of strategic commodities into regional or national blocks. The US dollar's dominance, partially underpinned by its role as the currency for commodity trade, would face an existential strain. The empty JPMorgan vault is not the end. It is the trigger. The crisis level it signals is a breach in the levee. The initial silent run provides the template, the depleted inventory provides the motive, and the structure of fractional reserve commodity banking ensures the panic. The system is now in a state of unstable equilibrium. It is waiting for the next sizable delivery notice, the next headline from a central bank, the next geopolitical shock that will convert this silent warning into a very loud and very global financial episode. The only remaining question for our final analysis is not if the dominoes will fall, but how the strategic player and the alert observer should position themselves before they do. The analysis concludes not with a prophecy of doom, but with a strategic recalibration. The events traced in the preceding parts are not a forecast of an unavoidable crash. They are a revelation of a new set of economic rules already in force. The silent $4.8 billion exit was a first-mover advantage executed in a changed landscape. For the business community, the aspiring entrepreneur, and the steward of capital, the imperative is no longer to predict the old cycles, but to understand this new calculus. Marcus shifts from historian to strategist, outlining the actionable principles for navigating a world where physical collateral has been weaponized by its scarcity. The first principle is the hierarchy of assets. The event establishes a clear, new ranking. At the top are essential, scarce physical goods with inelastic demand, productive land, water rights, energy sources, and critical minerals like silver, copper, and lithium. Below them are non-essential physical goods, collectibles, luxury items. Below these are productive equity in companies that control the aforementioned essentials. And at the bottom, now carrying a previously unappreciated risk premium, are financial claims on scarce physical goods, futures contracts, ETFs, and even cash itself, which are only as good as the system's ability to deliver the underlying asset. The smart capital is already moving up this hierarchy. The takeaway is to audit one's own portfolio or business model. How many layers of financial abstraction stand between you and something truly essential? The second principle is operational resilience over financial optimization. For decades, business strategy focused on lean operations, just-in-time inventory, and maximizing return on financial capital. This model is now perilously fragile. The new calculus prizes fat, not lean. It values secure, on-site inventory of critical inputs, even if it ties up capital. It invests in redundant supply chains, even at higher cost. It prioritizes ownership or long-term leases of key physical infrastructure. The entrepreneur looking to build a lasting enterprise must now factor in the tangible security of their operation as a primary competitive advantage, not an inefficient afterthought. A manufacturer holding a 6-month supply of silver-bearing components has a greater margin of safety than one relying on weekly deliveries from a broker dependent on COMEX inventory. The third principle is the geography of trust. The movement of metal out of a New York bank vault is a profound geopolitical signal. Capital is beginning to vote on which jurisdictions it considers secure for storing real wealth. This extends beyond commodities to data, intellectual property, and even talent. For the global business person, this means a deliberate diversification of assets and operations across jurisdictions with strong property rights, political stability, and a history of neutrality. The era of concentrating all assets within a single, dominant financial hub is ending. The new model is a network of fortified positions. Finally, this leads to the overarching mandate, the shift from speculation to stewardship. The speculative mindset seeks to profit from price movements in paper representations of value. The stewardship mindset, demonstrated by the shadow acquirer, seeks to control, protect, and utilize actual assets that will be necessary for future productivity and stability. For the individual, this may mean a modest allocation to physical bullion in secure, private storage, not as a trade, but as insurance. For the business leader, it means viewing the company's balance sheet not just in currency terms, but in terms of the essential resources and capabilities it commands. For the aspiring entrepreneur, it means building businesses that solve tangible problems in the physical world, whose value is inherent and cannot be erased by a ledger entry. The story that began with an empty vault ends with a clear directive. The $4.8 billion exodus was not an anomaly, it was an instruction. It revealed that the most sophisticated players are quietly exiting a game whose rules are changing. They are not waiting for a collapse. They are building a new board on which to play. The crisis level at JPMorgan's vault is, therefore, a line of demarcation. On one side is the old world of financial abstraction and systemic, interconnected risk. On the other is an emerging reality where value is once again rooted in the tangible, the useful, and the scarce. The warning has been sounded. The strategic response is not panic, but a purposeful, deliberate realignment along these new lines. The history of wealth is being rewritten in real time, not by words, but by actions. The only question that remains is whose side of history one chooses to be on.